Welcome to Common Sense Investing. My name is Cameron, and today I continue my journey in trying to find the next 10x penny stock. As always, I look forward to giving you introductions to good companies that also have the potential of being good stocks. Today I get to introduce and discuss some of the rewards and the risks of investing in Northstar Clean Technologies. This is a Canadian clean technology company focused on the sustainable recovery and reprocessing of asphalt shingles. Your roof, it literally trades on the ticker ROOF on the TSX Venture Exchange and on the OTCQB under ROOF with an extra O.
Local waste haulers and roofing contractors make the more sustainable choice and save money by turning away from landfills. Instead, they pay tipping fees to Northstar to drop at a Northstar facility for less than what they would pay to discard in a municipal landfill. Then, our proprietary design process technology separates the primary components into three outputs. These three outputs are then sold back into the market as repurposed materials. Our products are then reused for construction items like roads and embankments, and most importantly, new shingles.
And I like the idea of this, that they developed this proprietary design process for reprocessing discarded asphalt shingles away from the landfills. And I believe that future generations are going to make this world a better, more sustainable place to live. And it's not going to be done through overregulation from government or through carbon taxes. It's going to be done through technology. And this could be one of those technologies that does it. Now, one of the problems, though, is that they don't have much going on yet. They have a pilot facility in Vancouver where they have proofed this process, and they are currently constructing their first commercially ready facility in Calgary.
All of the equipment for the Calgary facility is being built off-site. So now that fabrication is complete, we are in the equipment testing phase. We're performance testing the equipment off-site to ensure that it operates as designed. This is an example of one of our conveyors. This one takes our ground up shingles from the collection hopper outside of the building into the aggregate separation system.
So once this facility is constructed, right, they're going to take asphalt shingles, they're going to grind them up, they're going to process and separate them. They're going to make money through these various revenue streams, such as tipping fees when people deposit the shingles at their plant. They're going to make liquid asphalt. They're going to produce fiber and aggregate to make more shingles and other things in the future, as well as a nice little bonus, though they're not relying on it, is environmental credit. And the business plan is attractive to more than just me. TAMCO, who is one of the largest shingle providers in the United States, funded Northstar with $10 million in strategic equity at 29 cents per share, which is higher than what they're sitting at today as I record this video. They also already have major offtake customers for their products. So once they start producing, they're going to already have revenue coming in. They also have feedstock supply agreements, so they're not going to be sitting there waiting for feedstock to come in. And before I look at the numbers, don't forget, not a financial advisor, definitely not your financial advisor. This video is not a solicitation to buy, sell, or hold this stock. These are just quick introductory videos to say, hey, this might be a company that's worth your time to research. And this is one of the risks for sure. I don't invest in pre-revenue companies. I won't even look at them. I would not be interested in Northstar if they were not so close to completing their facility in Calgary, but they do have a little bit of revenue coming in from their pilot in BC, and this tells me that the product is selling even at a small scale. Now, they are net income negative, 1.3 million, 1.5 million, pretty consistently in this number range. However, they're fairly well funded while they wait. 5.6 million in cash and cash equivalents and very low current debt. So when I'm looking at a stock, I'm constantly trying to figure out the potential rewards of where this company could go in the future versus the risks of what happens if something goes wrong. What are the risks and rewards of Northstar Clean Technologies? One of the rewards is their growth plan. I mean, they're supposed to get this first facility up and running in Calgary in 2025, but they plan to have 3 facilities in 2026. Once they have this many facilities, they're hopefully going to be able to self-fund, and you start to see exponential growth 6 facilities planned for 2027, all of a sudden 11 facilities planned for 2028, including getting these licensed facilities that might be cheaper for the company to build. Each facility, according to management estimates right now, is supposed to produce $9.7 million in revenue and $5.3 million in annual EBITDA. This is based on some pretty healthy margins of 66% gross and 55% EBITDA margin. What that translates out to, and look, this is very, very rough. These numbers are based on their projections for their first couple facilities up to and including 2026, I believe. But, you know, I don't know what these licensed facilities are going to look like as far as revenue, EBITDA, or what kind of licensing agreement they're going to have with that yet. But looking at the rough numbers, if they do get 6 facilities, their own facilities built in 2027, that's an estimated $58.2 million of revenue and $31.8 million in EBITDA, which is pretty significant growth from 2025. And by 2030, using, again, rough numbers, because, again, I don't know what the numbers for this are going to look like, but you're looking at something like $223 million in revenue and $121 million in EBITDA.
I mean, by 23 plants by 2030, everybody can say, well, it's a bit of a CEO arm wavy hockey stick. But to deliver what the industry needs by 2035, they want 200 plants to solve this problem.
This is a pretty aggressive growth plan, and of course it's using some rough calculation numbers, so I don't really expect the company to hit this 100%. But even if they can get close to these kind of numbers, looking at their today's share price of around 28 cents Canadian, there's a lot of potential reward here. More good and bad. TAMCO, the large single manufacturer, owns 19% of the company, so this is a good, large, stable shareholder. I highly doubt TAMCO is going to sell their shares anytime soon. The only thing I don't like is these are preferred shares. I like insiders and management, have skin in the game. 13% owned by insiders and management, 3% to institutions, so not discovered yet. This is still a retail stock at 65%. The only thing here that I'm not exactly fond of, 222 million shares. So this is not a low share count stock. And if Northstar can start funding themselves before they run out of cash, well, they might not need more share dilution. So go take a look for yourself, but Northstar Clean Technologies is definitely getting a spot on my watch list. As they develop this facility in Calgary, it will significantly de-risk the company. We can start to see the actual numbers coming in to see if they're going to get that 55% EBITDA margin and continue to prove out their forecasted growth plan by profitably reprocessing waste products, shingles, our roofs. I think that's fantastic.
Number one, this market size is absolutely huge. 16.5 million tons going into landfill across North America, and we're the only commercial technology available today to solve that.
Good enough to make my portfolio? Maybe not yet, but good enough to make my watch list. I really like Northstar Clean Technologies. I'm going to keep watching this company. You've been watching Common Sense Investing. My name is Cameron. As always, thank you for your time.